Good afternoon. This is Brian Shannon from AlphaTrends.net. Today is the 30th of January, 2008, and the market closed. S&P 500 did close with a loss of 91 cents, or about 2/3%. We're starting out with a 1-minute chart of the S&P 500. You can see that the market was basically just kind of marking time until the Federal Reserve finished with their meeting and announced a 50 basis point cut to interest rates. The market initially responded very enthusiastically with this large volume increase, and prices got bid higher. And then we saw bullishly that the volume pulled back. The volume diminished rather as the market pulled back and maintained above that rising VWAP for that period of the day. And then we had another thrust higher. But this time the market came down, sliced right through that daily VWAP, and you can see that we closed right near the lows of the days and gave up all of the prior rally attempt. You can see here that once again the 137 level. The market continues to have trouble with that area. That's the level again of the August lows. And you know, like I like to point out, the way that the markets traditionally move in relation to moving averages is they'll either find support in an uptrend near first the rising 10-day moving average, then the 20, and then the 50. Now on the way down, it looks like they found resistance once at the 20-day moving average, and now near that 20-day moving average. For the 10-day moving average right here, and now the 20-day moving average is where we seem to have found some sellers. The volume that we've seen this market rally on the last 3 or 4 days has been diminishing, and that put the market in a vulnerable position. Today the volume did pick up significantly, and we had a reversal of the day's gains. On the 10-minute time frame, though, you see where we came down to was right to that rising 5-day moving average. So you can't call it a complete failure yet, but when the overall trend is lower, like we see here in the daily time frame, there's really not much to hold on to bullishly here. You can see that the lows of the last 2 days have been violated, and the market closed below those as well. So it's going to have to really do some healing in here if it's going to have any chance of recovery. But again, the primary trend is lower, so the benefit of the doubt continues to go to the sellers in here. If we look at that 30-minute time frame once again, the here's that trend line for the year, and you could kind of call this bullish, but I mean it's not really bullish, but the potential to be bullish is the fact that this trend line acted as resistance, and now it seemed to have held there, also in the location of the 5-day moving average. So short term, it looks like we're back to very indecisive. It looked like the buyers were going to be back in control above this 136.5, 137 level. And again, I wanted to see, hopefully, that it would be able to hold above that 137 level. It was unable to do that, so again, we have to be very cautious of this market. The bigger level of concern for this market is going to be remaining at the 132 level. Breaking back below that, then I think that it's inevitable that we go back and test these lows. And I still think it would actually be bullish to test these lows here. If we came down and tested those lows on lighter volume, maybe we could clear the way for a potential recovery. But right now, we still have to give the benefit of the doubt to the sellers in this market. There's really just no reason to have any bullish hopes in here. And we continue to see more earnings reports, being negatively responded to with, Yahoo last night, and we'll see what happens to Amazon after the close here today shortly. The let's see, the semiconductors. Let's get to where's that symbol up here? Again, 365 is the key level for this market, and right now we're not seeing any signs that the market's about to get above that. So really just continue to stay on the sidelines in here. It does hold on, though. I mean, it's not really declining. In fact, it was up 0.25% today, and that 5-day moving average is beginning to rally a little bit. So it's showing a little bit of signs of stability, but stability isn't a reason to buy. It's only a reason to look at it and say, where are the key resistance levels, and if it can get above there, maybe we'll get a little short squeeze rally that would be worth trading, but definitely not any time to be doing any longer term buying. The Russell 2000, this market, made it past that level of resistance at 70.5 that we've been looking at as far as this inverted head and shoulders pattern goes as well. probably trapped a lot of buyers in there, and you have to look at this and say, you can't just buy a break of the neckline and then leave it alone. You have to look at it and say, can it hold for a period of time? And then if it fails, well, where does your stop go? So hopefully you didn't buy based on that inverted head and shoulders pattern being broken out. Or if you did buy it, there's nothing wrong with that, but hopefully you're not continuing to hold, because there's nothing wrong with being there's no sin, as they say, in being wrong. It's in staying wrong where the large losses come in the market. So this market also closed significantly below the daily VWAP, and we saw increase in volume in here as well. So the declining 20-day moving average seems to be acting as resistance here in the short term. Maybe we get a test eventually of these lows. It's still quite a distance away, about 8% or so. But with lighter volume on the rallies and heavier volume on the sell-offs, this is not a good sign for the market overall. And again, we've got all these moving averages heading lower, meaning that the 10-day trend is lower, the 20-day, the 50-day, the 200-day trends are all lower here. So there's nothing to be really bullish about in here. Short-term level of support, I think you can look at $69 a share. That was tested late in the afternoon, and that was the lows from earlier in the week as well. The more important level of support that, if broken, it's could lead to that test of the lows we saw from a week and a half ago. That would be the 67.5 level. Keep an eye on that. Breaking below there, again, could be much bigger trouble for this market. But if this market does have a chance of recovering, once you have this type of trap in here, it's going to take at least 3 to 4 days of recovery before it has the ability to do it. So I expect that the volatility will continue to be a little bit higher here over the next couple days as the market continues to absorb this news from the Fed and downgrades of the mortgage insurers and that sort of thing. So it remains a tricky environment and continues to be a short-term trader's environment. The NASDAQ 100, this market continues to be held captive below the declining 10-day moving average. So as we've seen, it is relatively the weakest group of these markets that I look at here each day. Big volume on the way down, followed by low volume rallies, classic bear market action. Bigger volume here again today as the market, these ones weren't down as much today, but overall for the week they have been. We're down 0.1% today, but clearly not a bullish looking picture. It looked like it was going to make it past, well, it did make it past this little short-term level of resistance, caught a bunch of stops up here, and then trap these buyers. So remember the phrase too, that from failed moves come fast moves. So be on high alert, because we've probably trapped a lot of longs with this break past resistance in these markets today, and got some of the weaker shorts out who are likely going to reevaluate their positions and add to their shorts once again. So the market remains very vulnerable, very weak in here. We've got this 5-day moving average kind of flattened out. The more important level of support for this market is going to be down near about $43.55. Breaking back below there, then I think the test of these lows near the 41.5 or so looks like the inevitable next downward target.